Today I want to talk about core investments, value-add investments, and opportunistic investments, and how these align with your short-term and long-term real estate investment goals. So let's dig right into it. A core investment is going to be your lowest risk but highest entry price type of investment. And why is that? Because it has a guaranteed rate of return or a stabilized asset. And what that means is great property management, fully occupied, great returns, good cash flow. But the opportunity to really change those variables, other than appreciation over the long term, is based upon its location, and it's based upon how well you manage that property for the long term. This is where you park money. So if you purchase another property and you sell it and you have some proceeds, but you want to get less risky, a core investment is the best type of investment property to park money for the long term, ride the appreciation, and when you do want to sell, be able to look at 1031 exchanges and other opportunities to basically diversify and park money in another core type of investment. Your wealthiest investors with the largest amount of assets are trying to achieve a core investment as their long-term goal. So they may take opportunistic investments and over the long term turn them into a core investment. The core investment has the highest purchase price. So to remember that. Net operating income, lower cap rate, higher net operating income, lower cap rate meets core investment. Is typically synonymous in that whole range. And that can be both commercial properties over 5 units as well as 1 to 4 unit investment properties. When it comes to value add investments, these are your middle of the road value add type of projects. Think house flipping, but for investment properties. This might be a realignment of a property management company, or hiring one and firing another one, or some repositioning of the property management plan, getting better tenants, filling some vacancies, remodeling some units, creating more net operating income, and lowering that cap rate in order to either do a cash out refinance or be able to reappraise that property and have that opportunity in the future, or be able to relist that property and be able to sell with that delta that you've just earned from your value add. Things to look for in a value add type of property are going to be deferred maintenance. They're going to be lower than market rents. You're going to look at things like bad property management, maybe a quasi location problem, meaning it's more up and coming, but it's not quite there yet. So there's all these little variables to look at when you're looking at value add. And this is primarily what syndication firms look for in terms of their number one target type of investment. Now, the most risky is opportunistic investments. Now, I like to caution everybody, opportunistic investments is like the major leagues of real estate investing. You don't go from core investments, that's something small, really well managed, and you don't want to put a lot of time or effort or planning into, and then jump into an opportunistic investment that is like value add on steroids. It's going to be a low purchase price, but a long-term to short-term value add project that includes many different variables. It may also include leveling the project and rebuilding. It could be purchasing a piece of land and holding on to it for a longer period of time in order to go through the permitting and zoning process to build what you want. So there's a lot of risk there. It's the most risk heavy investment type. But as the name quantifies what it really means, it's opportunistic. You saw the opportunity. It wasn't an immediate value add. It was a value add that took some strategy, more time management, more capital, and they're going to be typically lower price projects, or your C and D class type of investment projects that are you're trying to raise to a C and B plus, and maybe even an A. Now, what this really means with core, value add, and opportunistic is that when you come to me as a client and you say, hey, Dan, I want to buy my first investment property. And I always say, okay, what type of returns are you looking for? What would you like to do with that money in terms of the long-term, short-term? And how do we classify what types of properties to look for? Also, when we're looking at those types of properties, what type of due diligence process or what types of underwriting type of ability are we going to be able to look at those properties and say, hey, we see a lot of return here potentially, but this is what it's going to take to get into the project, and this is the timeline that we suggest understanding. So investing in properties doesn't just have to be about buying and holding. It doesn't have to be about buying and flipping. It can be about aligning your investment strategies into what type of asset class, what type of risk threshold, and what type of liquidity that you have or financeability to create a diversified investment plan that could be multi-tiered. It could be a group of single family homes you buy here, or duplexes, triplexes, or 4 units that you buy here, or a big multifamily project that might be an opportunistic type project. But we have to create that plan by looking at your experience, looking at what type of money you want to invest, how much time you have, and how much bandwidth and management that you want to personally put into it. All these different types of investment strategies or asset classes take all different variables of bandwidth, research, strategic planning, as well as having great relationships with contractors, zoning, planning, all of those little factors that come into play when it creating that long-term or short-term exit strategy. So I hope you find value with this. If you did, stay tuned to our next video. Hit the notification bell, subscribe to this YouTube channel. Thanks so much, and stay tuned for the next one, because I don't want you to miss the exit.